Natural gas isn't hated, but it's becoming hated. People are impatient for its moving. Lithium is certainly hated. I think it's going to become more hated. But I'm learning about lithium because I think a couple years from now, it will be as hated as uranium was in 2022. I think nickel, in particular, sulfide nickel is hated. I think you'll start to see a move up in the nickel price when, as, and if the problems in the Ukraine stop. The reason for that is that one of the reasons for the nickel price weakness is Russian dishoarding. But the truth is, Dunnigan, if you'll remember back about 3 years ago in interviews that we did, for your viewers, that would be the Paleolithic. But anyway, if you look pretty far back, what I said was that I like commodities that are necessary for the ongoing well-being of humankind, but priced on a global market at a discount to their production cost. So you look for something where the pricing is really, truly underwater, knowing that if it continues underwater, the commodity will become unavailable. So if it's a commodity that's needed for, maintaining the lifestyle of the human race, say like uranium for electricity, and it's priced below the cost of production, you know that either the lights go on or the price goes up. Lithium is not yet below the total cost of production, but I think it's headed that way. And I think the lithium-ion battery is important for the electrification of the world. So I'd be looking at lithium in the future. I'd be looking at platinum and palladium in the future. They're really in the toilets now. And I'd be looking at nickel. Natural gas, as a consequence of the fact that it's a byproduct often of oil production and oil prices is strong, probably doesn't yet qualify as hated, because most people look at oil and gas rather than just gas.
Renowned investor Rick Rule sheds light on 3 undervalued assets poised for a price surge: natural gas, lithium, and nickel. With demand outpacing supply and essential roles in energy and technology sectors, Rule predicts a significant uptick in their prices. He anticipates natural gas to rise alongside strong oil prices, while emphasizing lithium's crucial role in global electrification. Rule also discusses the potential for nickel prices to soar post-geopolitical tensions. His strategy emphasizes patience, market understanding, and reversion to mean for successful investing.
I'm a huge believer in 3 things. The first is compounding, which requires patience. A lot of investors who don't have a philosophical precept have trouble holding stock over a long weekend. The second thing that I think investors need to remember is that markets work over time. And if you're patient, time works for you. The cure for low prices is always low prices, and the cure for high prices are always high prices. It's difficult for people to understand that. High prices validate the theory that caused them to buy it, and they're loath to sell when prices are high, but they need to be, they need to be around that. The third thing is reversion to mean. We've talked before about, as an example, gold's median market share relative to other savings and investment classes. I don't know where the gold price is going to go. What I know is that in terms of its market share, about 0.5% of the market capitalization of all asset classes of savings and investment assets in the United States is denominated in precious metals. The 4-decade mean is 2%. Will it go to 3% or 4%? In other words, will it overshoot to the upside before settling out to mean? Likely. Will it actually revert to mean? Not exactly. But I'm a huge believer in reversion to mean. Once you start accommodating yourself to 3 things: patience, which is compounding, the fact that markets work, and reversion to mean, you are less inclined to going and chasing these idiotic fads. In particular, fad chasing is dangerous if you don't know anything about the underlying industries that you're trying to implement those strategies about. So people tell me all kinds of cool things about technology, and I listen to them out of interest because I'm an interested guy. but I don't invest in technology because I don't understand it. People tell me about all kinds of consumer trends. That's great. I love it. I'm glad that there's lots of things that people can buy that make them happier. But I'm disinclined myself to invest in them because I don't understand them. I stick to what I know. And by sticking to what I know, using time, which is to say compounding, the sense that markets work, and the concept of reversion to mean, over the fairly long term, I seem to do okay, irrespective of the fact that I'm not an ambulance chaser or a trend chaser. Well, I would suggest that if a company's principal line of business involves the exploration for the development of or the production of commodities, that it's a commodity centric stock. There certainly were 30 or 40 years ago lots of conglomerates that tried to be all things to all people and manage many businesses. Most of them found they couldn't manage any of them well and went back to some form of focus. But I would suspect that if you can determine from reading the company's annual report that their principal line of business is the exploration for development of or production of commodities, that by definition, they're a commodity or commodity centric stock.
Rick Rule discusses the surprising stagnation of gold prices despite looming economic challenges. Drawing from his experience in the inflationary 70s, he expresses astonishment at the delayed recognition of gold and silver's importance. Rule predicts a transformative era ahead, marked by the inevitability of currency debasement to tackle mounting debt and deficits. Despite the current lull in gold prices, he remains unfazed, foreseeing a potential extended period of stagnation unless specific conditions for decline emerge.
I'm a little surprised, frankly, that gold prices are as low as they are. Perhaps because I lived through the decade of the 70s, and I know what inflation looks like, and I know what stagflation looks like. And I know that the only way out of the fiscal situation that confronts the United States and many other countries is the debasement of the currency. I'm surprised that it has taken as long as it has for investors to come to understand that they need to own some gold and silver. Now, the truth is that if I paid more attention to my own personal history, this would be understandable. As a high school student in 1967, I began to be aware that the debt in the United States and the deficits associated with guns and butter were unsustainable. Did I do anything about it? No, I was a high school student and I was broke. But more importantly, did investors? No. The truth was, it took until 1972 or 1973 before the ravages of inflation had caught up with individual investors. Remember that by 1970, the world had been through 25 years of pretty benign economic climb after the end of World War II. And people were accustomed to think that things got better and better and better. And they didn't pay attention to nagging little problems like debt and deficits until over 5 years, the gasoline price went from 20 cents a gallon to $1 a gallon. Until the price of a hamburger at McDonald's went from $5 to $1, which is to say 20 cents each, to 75 cents each. After 5 years, the perniciousness of inflation became apparent to people, and they began to pay attention to it. So the fact that it's taken people some time after a 40-year period of benign economic climate makes absolute sense to me when I think of it in that context. It's my belief that we have, for the purposes of this discussion, two time frames to talk about, 1982 to 2022, with US dollar hegemony very strong and the interest rate, both nominal and real, falling. And then we have a sea change at the end of 2022 with the interest rate rising. That interest rate rising heralds the beginnings of a new era, one that will survive, but one that will be challenging. The circumstance that we have in front of us, the debt and deficit in the United States, we've seen before. You will not cut spending. That's not what the voters will tolerate. And you won't raise taxes too much. So how do you get out of there? Well, you debase the purchasing power of the currency. In other words, you devalue the debt that you have by printing. In the decade of the 1970s, we devalued the US dollar in terms of the basket of goods and services that Americans live on by over 80%. And of course, that coincided with the meteoric rise in the gold price. The way we get out of stagflation this time is very likely the debasement of the currency that the debt is denominated in. So I think past is prologue. That's a long-winded answer by way of saying no, unless the conditions precedent for a decline in gold come to exist, which is to say a balanced budget, positive real interest rates, and the end to quantitative easing, I'm not afraid of another 15 years of stagnant gold prices.
Thanks for joining us today. Here's a quick recap. Rick Rule discussed the potential price surge of natural gas, lithium, and nickel, emphasizing patience and market understanding. He also touched on the surprising stagnation of gold prices amid economic challenges. Remember to subscribe, like, and share your thoughts in the comments below. See you next time.